welcome along to the Property Academy podcast. I'm your host, Steve McKnight.
And I'm Andrew Nicol.
And tell the show, we're talking about are property investors making more money and how have yields changed over time? How have rental yields changed over time? Now, this comes from a listener of the show, Cam, who said, hey, I've got an idea for a podcast. Want you to talk about how yields have changed over time. Not a lot of data about that on the internet. Just want to see what's happened. And it's quite interesting, Andrew. I've been rereading Dolf De Roos's book,
Have you?
Real Estate Riches.
Have you? Is it my copy?
No, Kindle. I got the Kindle version, which is $30 on Amazon. And I thought, I should read this. And I saw, I think on about page 87 or something like that. Something like that. It caught my eye, and he says that he actually does say words like fabulous, doesn't he? One fabulous investment I came across many years ago was advertised by a real estate agent as a column, an ad, a classified section in a newspaper. So it must have been many years ago if he's looking at the newspaper. It concerned a tiny little 85 square metre property on the corner of a busy intersection. It was the only commercially zoned property in the residential suburb, and the tenant was a fish supply shop. Now, the rent was $10,400 a year. The asking price was $59,000. So it's back in the Stone Age, giving a gross yield of 17.63%. And I think Cam's question is a really good one because books last for ages. And what can often quite happen is the numbers quickly come out of date. You've got to remember that Dolf's book, which is an excellent book, is 22 years old, first published in 2001. And even then, he was saying that this story came from many years ago. So we don't know whether that story is 30 years old or maybe even up to 40 years old, maybe even longer. And so is that sort of gross yield still realistic in today's market? That's what I want to dive into with Cam's question. Now, Andrew, what do you think? Are those kind of numbers realistic today for a commercial property, 17.63%?
Absolutely not. If it was, I'd go out and I'd buy 100 of those things.
We'd be starting fish supply shops.
Those numbers are a thing of the past. And you've got to think about it this way. Like, rents have gone up and incomes have gone up by, say, 4.7% a year. House prices have gone up, historically by, say, 7% a year. So house prices have gone up at a greater rate than incomes have. And so there is going to be a downward pressure on yields. And
so let's look at some of the data, and we're going to start with Invercargill because it's always been a bit of a property hotspot for investors. What we've seen, and I've only got data back to 1993, but it's about 30 years of good data. What we see is average gross yield back then would have been about, kind of 8% back in 1993, 8.3%. What we actually saw is that yields actually increased through to about 2002. So for 10 years, actually, we saw the average yield in Invercargill increase quite substantially. And the reason is that we saw rents go up faster than house prices. House prices were staying, roughly the same. They stayed flat for basically 10 years while rents were still going up a little bit. Rents had increased 25%. House prices were staying exactly as they were. And because of that, we saw yields go up.
And it's funny because around that time at the peak of the yields, that was the time that I was starting to educate myself around property investment, and Invercargill was one of those places that was the hot spots to invest.
Well, it's always been attractive for investors because Invercargill house prices are about a third that of Auckland. Yeah. And so we often, especially in Auckland circles, they go, oh my God, house prices are so cheap there. Rental yield's pretty good. Let's all go down there. And then what happens? Well, we saw house prices then increase about 100. Oh my God, I didn't realize that. They tripled. They basically tripled. They went up by 190% in the space of 6 years. So house prices went up substantially faster than rents. Rents pretty much plateaued at that time. And so what did we see? We see the average gross yield go from about 10%, 10.73%, and it crashed down to about 4.7% by the height of the GFC by the end of 2007. And so we saw a rapid structural change in the Invercargill property market because those house prices rocketed up, rents didn't keep up as quickly, and so we saw yields decrease over that that time. They recovered a little bit. They got up to a year around that kind of 6% mark from 2016 as, house prices started to stabilize again, rents started catching up. Then we saw house prices go up, and yes, we saw rents go up, but we have seen the average yield in Invercargill drop to about that kind of 4%, going up to that 5%. Some of the figures we're quoting are slightly different from other podcasts we've done in the past, or recent podcast episodes, just because we're using slightly different data here. We're using average house price or average sale price of a house and average rent in Invercargill as well. But the trend is what we're looking at, and this is going to be pretty accurate here. Massive changes in Invercargill.
What about somewhere like Auckland?
So if we look at Auckland, we see something quite a bit different. The decreases in yields have been pretty constant. The Auckland property market has been increasing pretty consistently in house prices over time, and so we see that nice smooth increase. Whereas if you compare that to Invercargill, it's been a bit choppy. So house prices stable for a very long period, then we see a boom. Then house prices stable for a very long period, then we see a boom. You don't see that as much in Auckland. We see more, house prices tend to increase at a more stable rate. Because of that, we have seen yields in Auckland fall pretty sharply. So, back in 1992, 6.6%, pretty standard, and then we see a decrease. Once we get to, kind of mid-2007, we get to just under 4%, stayed around there for a while. At the peak of the market in November 2021, you're looking at a 2.5% gross yield by this data. Come back a little bit, up to around that 3.3% mark as house prices have come down. Rents have continued to go up a little bit, but it's been quite a stable decrease. Now, to answer Cam's question, what are we seeing with yields? We are seeing a real decline in yields over time as house prices have increased, and we've seen rents not keep up with that.
And is that purely because prices have gone up at a faster rate than incomes have?
Not necessarily. Probably it does come down to the faster rate than incomes, but it's all about the relative rate between house prices and rents. Rents do tend to be tied very closely to income, so that's probably a fair assumption.
Do you think that a continuing decline in long-term interest rate might also have an effect?
I think that is probably the primary driver that we've seen. But remember, we've done podcasts in the past where we've seen interest rates gradually coming down, not just over the last 30 years, but I think we looked at 700 years at one point in time.
Yeah, we took a long length of time for that one. Some long data.
We have seen interest rates gradually decline. That has caused asset prices to obviously increase at a faster rate. That's one of the reasons why we tend to be more conservative into the future. If Auckland house prices have increased by 7% in the past, we usually say, okay, maybe it'll be 6% in the future. If house prices outside of Auckland have increased by about 6.2% in the past per year, we tend to say 5% within that. But that's where but the key point I want to focus on is that we have seen that gradual decline. There's going to be a natural flaw to this, right? Like you're unlikely to see a 0% yield. So if I was to draw a trend line in Auckland's data, that would suggest that maybe we'll get to a 0% yield by the year, 2055. Unlikely to happen. So we're probably going to see this realign in future. And that's one of the reasons why, again, outside of Auckland, we say house prices might go up by 5%, rents might go up by 4.7%. You'll probably still see some gradual decline in yields, but at a slower and slower rate is what I'm picking. But what we've seen is that over the last 30 years, the average yield has kind of halved. In some cases, it's gone down by a third. So somewhere between, yields today are about a third to a half of what they were probably about 30 years ago. And what would that look like if we applied that to Dolf's example?
Dolf was talking about an 18% gross yield for commercial property, and that was 30 to 40 years ago. And if we said, okay, well, a third to half of that is 6 to 9%, something closer to 6% is probably quite realistic for a commercial property nowadays. So that seems about right in terms of those numbers, in terms of applying that discount.
Yeah, so if you're reading a book from maybe 30 to 40 years ago, or even a book that was written 20 years ago, but it's referencing stories from a long time before that, that's where you might want to, roughly half the yield, or maybe take 2/3 off that yield to get a sense of what might be applicable today. That is a very ballpark guideline, so it's not going to be entirely accurate, but just to get a sense of what is realistic. I mean, I remember when we wrote our book, Wealth Plan, now available in bookstores across the country, by the way. You should pick up a copy if you haven't already. We say the numbers in this book will get horrifically out of date very, very quickly. So, just be aware that books, when you read books from 20, 30 years ago, those yields are not going to be available today.
I think when I read Dolf De Roos's book, maybe 15 years ago, the numbers were out of date then. Like, you talk about a house for like $98,000 and you thought, that was wild. Do you know he used to live in Christchurch?
I remember you used to tell me that he'd ride around on his bicycle.
I was just doing that just to wind you up, yeah.
Yeah, I've heard that story. Well, I mean, and actually, even if I'm thinking about our book as well, because we started writing that, it took us 2 years to write the book. When I did my final review of it, I'm like, I need to update these numbers, because even then they were out of date because house prices had spiked, then they were coming down, and so we were updating that to the last minute to make sure that the figures were as accurate as possible. So things do change very quickly, even when books first come out. But main thing for you, Cam, yes, yields are coming down, and I know you want access to this data, so I'll get my team to put this somewhere on our website. It'll probably be done in the next couple of weeks. Right, let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Really does help us get the message out to more people. And tell you, if you're listening to the podcast, you've got your earbuds in your ears, maybe at the gym, and you want to see the graphs I'm talking about, just Google Opus Partners YouTube. We've got them up there for you. And obviously, if you're watching the YouTube, make sure you hit subscribe. It really does help us get the message out to more people. Thanks for listening to the Property Academy podcast. I'm your host, Stephen Knight.
I'm Andrew Nicol.
We're going to make...
We'll be back again tomorrow with more daily strategies, tactics, and tips.
Insights to help you get the most out of the New Zealand property market.
Until next time.